So let's transition a second. Because we've talked about owners and we've talked about existing ESOPs. Let's talk about the benefits to employees from being in an ESOP. What I guess from my perspective, having served on ESOP boards and just looking at the statistics, there's a lot of benefits from both employee engagement being better within an ESOP structure. I think in the most recent study in 2023 that the National Center for Employee Ownership did, voluntary quit rates were about a third of what there was on the national average, right? So you get tenure, you get continuity of employment, you get passion and engagement. And then the benefits from being from actually participating in it as a retirement plan, the retirement assets, when they looked at S Corp ESOPs and this was in 2023, employee owners had more than double the retirement savings compared to their non-ESOP counterparts. So on average, 80,000 compared to 30,000 in their retirement plans. So those are pretty significant benefits to the employee of being a part of that, being part of an ESOP. So what do you guys see when you're looking at ESOPs as the benefits to the employees? Anything you'd like to add?
Sure, Gail, do you want to go first?
Well, I'll go first and then turn to you. I think you've hit it well, Chris. I think it shows that level of engagement that is just enhanced when you have the employee ownership. You have really the most pure form of pay for performance, right? That the whole organization is benefiting from the efforts of the whole participating workforce.
Yeah, and we started out talking about all the benefits to the selling owners and the company and all that. But for the employees, this is a life changer. They would never, ever accumulate the amount of wealth that they will in these plans. For everybody on this call, you can afterwards just Google Forbes' Tale of Two Sisters. It's an article that Forbes and NCO has about two sisters that were both checkers at grocery stores. Winco Foods had a policy where they couldn't hire, two family members. So one sister got hired out at Winco, which is an ESOP company, and the other at one that was not an ESOP company. Fast forward, as you'll read in the article, 20 years later, the one sister that was part of an ESOP company had over $1 million in her ESOP balance. The sister that was not had about 30,000 in her 401k. That's a game changer, a significant difference. So for the employees that are participants and owners in these companies, it's a life changer.
And we've got a couple questions on this, both about, are there tax benefits to the employees in this? Because we talked about the tax benefits to the other constituents. And then also, so when can the employee liquidate their ownership, right? So when do they actually realize some of that ownership? So one of you want to tackle that?
I mean, I can speak to it a little bit, and then Carrie can chime in. I think that tax benefits, that's an easy one. It's just like any other, largely like any other qualified plan. You've got deferral of taxation on the benefits in that trust. So until the funds are distributed, you're not going to be taxed on the value. So that's of course huge. This is now I'm just talking about to the employee, the benefits, and then the distributions. I think in some ways that goes to some of the downsides to an employee of these kind of arrangements, because the values are there, as Carrie said, but they can be less accessible in an ESOP to employees than they would be to employees in a 401k or profit sharing plan, for example, that people are generally very familiar with. There can be payouts can be deferred, retirement, death, and disability. The year after termination, they can, is the earliest they're required to be paid out. So that can postpone it quite a bit. And then if it's just a regular termination, those distributions can be postponed for 5 years and then paid over a series of years, depending on the value of the benefit. So, and if the plan's leveraged, then the plan can defer distributions until the loan is repaid. So the accessibility to that value can be a perceived limitation. It also can be one of the things that gives it the ability to compound so powerfully. But Carrie, what do you think?
I agree with everything you said, Gail, but just maybe a little different twist on it. I agree with you. It's just like a 401k, right? So but one of the things that I think is important to point out, because a lot of times people, when they're learning about ESOPs, they say, okay, and then so the employees are contributing and buying in. And it's like, no. They don't pay anything. So they're getting, every time those owners are getting paid off, those shares are getting allocated to the employees for zero. So the employees pay nothing. They get these balances that are contributing. And then, as Gail said, then it's going to compound on a tax deferred basis. And so, yeah, there's going to be a time where it comes time to distribute the money out, and then it's ordinary income, just like in a 401k. But they do get all this free money that gets to compound for a number of years. Make no mistake, these ESOPs are geared to benefit long-term employees, and long-term employees are going to reap huge benefits. One of the things Gail mentioned, which is critical too, about accessibility. Look, humans are humans. And if you have some 32-year-old that all at once gets an annual benefit statement and sees that, oh wow, I have $100,000 in my ESOP account. I'm a little tired, and I got plenty of time to go back to work. You know what, Mr. Owner, thank you very much. I think I'll take a break and I'll come back later. So give me my 100,000. Well, now the owner can go to that, and we call that calling in rich. And so you want to design it so they can't call in rich, and because then that hurts them. It hurts the company, hurts them. So they have these distribution policies to protect them from themselves. Say they have to wait 5 years and to get paid out over 5 years. Now that 32-year-old may say, oh, never mind. It's okay, I'll wait. So again, this is to benefit long-term employees.
And I know, Gail, when we had talked in the prep call, you had talked about the risk from employees having all of their wealth then tied up in the same place where they're being employed, right? So their retirement assets are in with the company, their compensation's coming from the company.
Right.
But so can you talk about some of the structural diversification that's required in order to allow people to mitigate the risk?
Mitigating that risk. Yeah, it is a risk. Of course, it's a risk many, of course, directors are familiar with the C-suite of having so much of their income riding on the performance of the company or the equity values. And now you're talking about really putting that scheme in place in a way that impacts all your employee workforce. So their job is dependent on this company. Their retirement security is dependent on this company. That can be, as you say, a lot of eggs in one basket. And because of that, there is a diversification requirement that the ESOPs have to have, but it applies to those who have 10 years of plan participation and are age 55 and older. And then you can diversify over time, 25% a year. At age 60, I think it goes up to 50% a year. So there is a recognition that as these long service employees get closer to retirement, they need a sort of an off-ramp from that risk. And so that's built into the ESOP rules in a way.
They could diversify that into another kind of IRA kind of program if they want to.
Right.
At that point.
Or just diversify the type, even holdings within the trust into a different form of investment.
Something that's not that. We've had a fair amount of questions that I would call are kind of for company partial ESOPs, right? If a company wants to create an ESOP within the company for as an employee benefit, even if the control is a public or a primary shareholder. Do you want to comment on that kind of strategy? The questions were amongst, could you create an ESOP versus giving phantom stock to someone? I think was one of the questions that came in. And how would a company, could a company that's structured differently just have an ESOP as an employee stock ownership plan as a benefit within the benefit set?
Yeah, Carrie, do you?
Yeah, absolutely. I mean, yes, and we actually prefer to do partial ESOPs. You can always do another sale later on and sell the rest of it, but you know, it's we'd rather see them break it up into segments and do a partial ESOP. So the answer is yes. Could you just sell part of the company? Yeah, you could. You have to at least, if the owners are interested in doing that 1042 thing we talked about earlier, they have to at least sell 30% in aggregate between owner or owners to qualify to do 1042. But yes, you could do a partial sale to an ESOP. And the owners are typically the chairman of the board, so that control thing comes into where they say, well, you know, what happens if I sell part of my company? It's a big benefit, good retention and attraction tool for employees, and very powerful. But owners can still, because they control the, you know, or chairman of the board or whatever, can still receive their salaries and maintain. Nothing has to change. Just a nice benefit.
And I think one of the really interesting things about ESOPs is they are all different from each other, because however you write your plan, that's how your ESOP has to be governed. But there's a lot of flexibility in how you structure and write that plan at the beginning. So in addition to kind of advice for future directors of ESOPs, like it's really good to read the plan when you first join the ESOP board to understand what the real attributes, because unlike with public companies or other kinds of structures where it's more obvious and it's more standardized, with ESOPs, it's very different.
And Chris, I wanted to circle back to a question that you'd asked earlier that I don't think we've gotten to fully yet, which is what are the employees' rights? Which is certainly they have a right to receive the annual benefit statement you've already mentioned. They have a right to a summary annual report, which annually, as it indicates, that summarizes the Form 5500 that you're required to file with the government. They have a right to receive a summary plan description that should clearly outline the terms of the plan, so they can look at that and review it and keep it. And it's important to keep it updated. That tends to be something that can fall through the cracks. For public companies, as you mentioned, you would pass through the voting rights. For private companies, you wouldn't necessarily pass through voting rights, although you are required to pass them through if it's a potential sale involving all or substantially all the assets of the business, or merger, dissolution, or liquidation. Then you do have to pass it through. But otherwise, it's that balance of keeping the employees engaged, informed, being as transparent as is beneficial, without creating the wrong impression that you've turned over all your governance to a group of employees acting together.
Yeah, and I think, thank you for circling back to that question, because that was an important one to think about what they are. And some ESOPs might put a average employee, a typical employee, on the board. Ones I've been involved with have not. We often have, members of the executive team on the board, more than you might find at a public company. But it's, that's up to the individual structure. There are many ESOPs that have what I would consider as a kind of world-class governance board, where maybe only the CEO is on the board, right? And the rest are independent directors.